So I'm going to keep it very, very brief and informal. There is no magic formula for investing and making money. You need to learn it the hard way. But I just got some ideas and really more, I would say, experiences from my personal journey of investing. And I've been investing for the last 30 years in listed stocks as well as various other financial instruments. And I thought we'll keep it to the stock story here today. And just a few rules I thought that may be good in terms of pitfalls to avoid, right, when you're investing. Probably some of you may be seasoned investors already, but very, very basic stuff. I've learned the hard way. There's, like I said, no magic formula. Just to give you some context, I'm a very aggressive investor. I take a lot of risk. My approach may not be ideal for everyone, so do take it in that context. Each of us have different objectives to achieve out of investment. Mine are probably very different to what yours are. But a lot of my learnings have come from the hard way of learning through experience and actually losing money, right? And I've lost a lot of money along the way, and I'm not shy about it because I think that has taught me a lot of lessons and things not to do in terms of this. So let's quickly go into. I didn't know I was sponsored. Right. So it says it's a crash course. But you can see both the bull and the bear. All right. Just for those who don't know the meaning of bull and bear, the bull signifies a bullish market, a market that's climbing in price and doing well. The bear signifies a bearish market when it's actually tanking down and declining. The important thing to remember is that you can make money on both these markets. A lot of people think you can only make money in stocks when share prices appreciate. It's not the case. Even in Sri Lanka, we have what is called stock borrowing and lending and regulated short selling, right? So you can actually sell a share you don't have if you think the price is going to decline, right? So that's why I think it's important to know that both the bull and the bear can be your friend. So first tip, start small. Think big but start small. A lot of people don't get around to make their first investment because they feel that that investment is insignificant and that's not enough money. All right? That's a misconception. You can start very, very small, and if you're asking me how small, it's as small as 1,000 rupees. Is that small enough for you? Yeah. So you can start with 1,000 rupees. So don't feel shy. If you're someone doing a very first job, earning, 25,000-30,000 rupees, set aside 1,000 rupees from your salary and start investing. Right? It's a start, but dream big. So I think first tip is sort of look at that, right? Dip. It says dip your toes in the water before jumping in, right? Warren Buffett said you never test the depth of a river with both feet. Test it with one, right? You probably heard this, don't put all your eggs in one basket. So I think the secret to investing is diversification and not going into one stock. As a rule of thumb for me personally, you have 3 asset classes in Sri Lanka that you can invest in broadly, right? So you have real estate. So it's always good to have some part of real estate, at least the home you live in is what you own, right? Then you have fixed income instruments, right? FIS we call it. Fixed income means it gives you a fixed rate of return, an interest-bearing instrument. So fixed deposits in a bank is a fixed income investment. A savings account is also a call deposit. It also a listed debenture, a commercial paper, a securitized paper, whatever form it takes, A income instrument is the next asset class, the interest bearing or a coupon bearing instrument that you know you put X and you get Y at maturity, or you put X and you get Y as a coupon paid to you and X back at maturity. Whatever, it's a fixed rate. You're not taking too much risk. The only risk you're taking is the risk of who you gave that money to. Whether they will default, there's not much of a risk of whether you get that return or not. Your return is virtually guaranteed. So second asset class is fixed income, and the third is equity, right? Buying shares, whether they are listed or unlisted, shares of a company, and your returns are then based on essentially how much profit that company makes and the dividend it declares. So three broad asset classes. I'm ignoring some others like gold, commodities, crypto, because they aren't widely accessible to the common Sri Lankan. So you have real estate, you have fixed income, you have equity. My rule of thumb that I have followed is 1/3, 1/3, 1/3. So I don't put too much of my wealth into any one asset classes of equity, fixed income or real estate. Very broadly those three. However, during certain economic cycles, you may change that allocation, giving more to fixed income, less to equity, or vice versa. For example, right now, we are in an environment where interest rates are very low. It's single digit. So you go to a bank, you're probably going to get 7% as an interest rate, not more than that. 7, 8, we'll say at maximum maybe 10-ish is what you can get currently. It's low in this country. We've had interest rates of 30-40% as well, right? So then you may want to lower your allocation in fixed income and not have 1/3, maybe only have 1/5, 20%. And right now, equity markets are doing well, shares are doing well. Why? Because the economy is growing, rebounding from a crisis, companies are making more profits, people are looking at tax efficient asset class, so they are choosing equity over fixed income. So you may want to then increase your allocation into equity. Similarly, you may say the house I live in, I want to be mine, but I don't want too much other property because that's really sort of locked in. I can't generate too much of an income. Rental yields are very low in Sri Lanka. But you may then say, okay, like now is a boom time for real estate, so therefore I'm going to move from equity into real estate. So you may change that allocation, but general rule of thumb for me is a 1/3 and switch that allocation based on the timing, right? So diversification is important, and in the example of investing in the share market, I'm saying pick many stocks over picking one stock. Very important. Focus on fundamentally strong quality stocks that have value, right? The Colombo Stock Exchange has 285 companies listed. I'm not going to tell you as ex-chairman which are good and which are bad, but there are 285 listed. You need to do your homework and look at valuations and look at that and see which of these hold value, which of these hold promise of a higher appreciation, which of these are well-managed companies run by competent managers, which of these have shareholders who have governance practices of not screwing over the minority shareholder, that's you, who bought the share in the stock market, and play a fair game. So I mean, just to pick a few names, if you're talking of the likes of John Keys Holdings, Commercial Bank, Haley's, big, fundamentally strong, performing companies with proper governance, you know there is no hanky-panky happening there. They publish their results timely to the public. That's a fundamentally strong stock, right? So look at those stocks, see whether they are valued appropriately, then choose whether you should sort of. So it's like, you know, whether you want a reliable, sturdy bike when you're going on a journey, or do you want something that's going to just keep breaking down every time something bad happens. Yeah. Think long term, especially in stocks, there is no quick win. Okay, you will be lucky if you have a quick win, and sometimes you are, sometimes you're not. But pick stocks and have patience. Stocks are medium to long-term investments. They are not for you to invest today and think in a week's time I'm going to double my money. If anyone tells you that you can buy a stock today and you can double your money in a shorter period of time, run a mile away from them. Don't buy that share, right? Because that itself is they're selling you a story, right? And a lot of our people in our market unfortunately get caught to this. It's called the herd mentality, right? It's like in the Masai Mara, if you've seen, big herds crossing the river, all the crocodiles are there. It just takes one of those wildebeest or buffaloes to make that charge. The rest of the herd just follow it. That's the herd mentality, right? Don't do that, because there are crocs waiting for you while you're trying to cross that river, right? So if someone tells you this is the hot pit stock, it's going to go, this is going to happen, that's going to happen, it's a load of bunker, right? BS, don't buy it. So look at long term, and I think the cartoon illustrates it. You actually invest in stocks, and probably the real value of that may be even the next generation, right? Have you heard of a saying in Sinhala, Utsavantaya Jayagani? Actually, it's Utsavantaya Puta Jayagani. That's the example, right? My kids know that, so. Bring your zen. Stay calm, all right? Very, very good example. Monday, war broke out in the Middle East. I think it was Monday, I may have got the date wrong, or maybe it's Friday. The all-share price index touched an all-time high of 17,660 5-6 days ago. All indications were that it would probably go up higher. And Israel bombed Iran, and this happened, and we had 5 days of market losses. It broke 17,000. Yesterday it closed at 16,900, and I can tell you a lot of people panic sold, right? So it lost a good 4%, 5% even in a matter of 4 days. But that's an external event that may or may not have implications to Sri Lanka. We don't know that yet, it's too early. Yes, oil has spiked up, but the economic fallout of what's happening in the Middle East is an unknown, right? God knows what will happen. None of us know what will happen, right? But there are people who will predict and say doomsday, this and that. And I know a lot of people who sold, so you had that huge correction of 5%. Today the market is up to 170 points, right? And I pity those guys who exited yesterday, right? But that's why, don't panic. Markets will go up and down. Remember why you invested, right? You bought a share because you saw value in it. You then have a target price that it will hit over a period of time. Wait it out, right? Don't just go rush in there and sell and cut and realize. So again, stay focused on your goal, right? Your goal is to build wealth, and wealth is not built overnight. If any of you play the guitar, if you just keep that lying around, it goes out of tune, right? So you need to tune the instrument for it to be in optimum sort of, status, giving the best sound. So I think constantly looking at your portfolio, reevaluating, realigning is required if you're investing. You can't just buy it and forget about it and say, I bought it. Now he told me long term, no. So for the next 3 years, I'm not going to even look at it. You can't do that, right? While you buy and you invest for that period, all listed companies are required to publish their financial statements on a quarterly basis. So every quarter you get a profit and loss account, balance sheet, the company tells you what it has done, right? You look at it and see, now is my original assumption still valid? Has it changed? Has it got better? Then should I increase more shares and buy? Or is it worse than what I thought? So should I actually maybe decrease exposure and buy something else, right? So constantly reviewing, and in my view, you would at least have to review your portfolio on a quarterly basis, every 3 months. Because the company earnings come every quarter, I don't think you can not do it and just forget about it even for a year, right? So constantly looking at it and tuning it is sort of very important. I didn't know we had a lecture break. Back to the boring stuff in the stock market. That looked much better, the apartment complex. Yeah, so again, next tip, the don'ts, right? Avoid hot tips, topics, stories that people tell you, right? And I think, like I said earlier, don't panic just because prices go down, stay focused. But this is very, very important because this is something that happens in our market, unfortunately, right? People cook up a fairy tale version and tell that and start spreading it. And when too many investors believe it, it's sort of like a self-fulfilling prophecy, and that takes the share price up. But then those very people who may be behind that story will dump it at the time when you guys go and start buying it. So please don't sort of do that. It's absolute rubbish. Whatever that you do has to be based on numbers, financials, all of that. I'll tell you something that I got caught to long years ago. I'm not ashamed to say I got caught to. This is probably 17 years old, 18 years old. There was this company, I'm not going to name the company, but this share was listed. It was virtually a dormant company, right? It was doing nothing. It was making some little small investments, so it had no real business operation. But one fine day, they sent out a rumor saying, they are buying a platinum mine in South Africa. And they are getting this for dirt cheap price of $2 million. And surely enough, a lot of people caught on to that story, and the share, which was at that time, I think 30 cents, right? 30 cents. That share went up to almost 30 rupees, a 300x on your return. So if you bought it at 30 cents, in a couple of months, you have this share trading at almost 30 rupees, right? And then one fine day, actually the company made a disclosure that, yes, we bought a platinum mine in South Africa, right? But what they actually bought was an abandoned mine in South Africa, right? It was long, they had, I think, mined all the platinum out of it 20 years ago, and people got caught to it, and yours truly got caught to it also, right? I'm not ashamed to say it, even though I was somewhat of a professional investor. So don't believe in those fairy tale stories. If someone tells you that, just give me the last financials. Companies have to disclose any business price sensitive information. So if they're going to buy a platinum mine, they have to declare that in their financials, right? And if it's not there, don't believe it. So I think that avoiding hot tips and quick tricks are sort of, that's very, very important. Stop loss orders, right? This goes for take profit as well. What it means is when you buy a share, we'll say you bought something at 10 rupees per share. Because you did your analysis, you did all the steps that I told you before, and you thought this price really is undervalued, that this will go to now 15 rupees in 1 year's time. So you have a 50% target appreciation when you got into that, and that's fine. But at the point of getting in, do you know what your tolerance of risk is? How much are you willing to lose maximum? Right? You need to figure that out, right? So if you bought it at 10 expecting 15, how much are you going to walk away with at a minimum? Because there's no guarantee that 10 will be 10. 10 can be 5, right? So we'll assume you were conservative and you said, okay, I can stomach a 10% loss, a 1 rupee loss. So I bought it at 10. Maybe if it drops to 9, I can stomach that one losing a rupee, right? Put a stop loss order, and you can do that into the trading system automatically, or you can tell your broker that, hey, I bought this at 10 thinking I will hold it till 15, but if it falls to 9, I want you to sell, cut my loss and get out with that 1 rupee. It's called a cut loss limit, right? Cut loss order. So having a discipline to cut your losses as well as take your profits at a particular time, now we'll say 15 on that same we'll say it goes to 15, but you get greedy and someone tells you no, it will go to 20, and you think, oh, I shouldn't sell at 15, I'll buy more at 15, but then it doesn't, and it actually falls to back to 10. You've lost money now, right? So have the discipline to cut your losses, take your profits. Don't be too greedy. Don't be too greedy even to realize the loss and get out. You're better out than that, because if you get out at 9 and then it falls to 5, you're okay, no? You just lost a rupee. So next lesson is that then you can be, I think many of you are professionals having day jobs. You may not have time for all of this, right? You can't be analyzing stocks, you can't be spending time, you have enough things to do. Pretty simple, go to a fund manager, go to a unit trust. So there are unit trusts that invest in equity, in fixed income, in whatever category of assets that you want, that are professionally managed by a set of guys who are paid to just do that. And all you do is just put your money in, you buy a unit of a big fund that they are managing. So you have, we'll say 100,000 rupees, you go and invest 100,000 rupees. There are thousands of people like you who invest different hundreds of thousands of rupees. The fund is 100 million fund. So that fund manager is managing a fund of a big 100 million, not your 100,000. So it's worth his while. And he puts the research, he does his homework, he does all of that. All you have to do is just reap the reward. So if you don't have time to do all of this and think it's a waste of time, just use this, right? It's so easy. And you can invest in unit trust with a minimum of 1,000 rupees. Huh? It doesn't take a lot of money to do that. Keep learning, stay patient, right? No one is a master, right? I learn every day. I still make mistakes in investing. I don't get them all right, right? But then that teaches you something. Don't go and repeat that same mistake again. If you keep repeating that same mistake, then there's no one else to blame but yourself, right? Learn what you didn't do right, and then maybe don't do it again. And there's a lot of material in terms of reading, and today you even have AI, right? So you can actually have AI programs that will look at algorithms and tell you what is the most probable, what is the best case scenario. There are a couple of platforms that are already offering that. I'm not advising anyone to take that, but there is technology, and technology is evolving at such a rapid pace today. Use it. So I think that's my 10 tips, right? But the final message I think to all of you is that, in investing, what is comfortable is rarely profitable, right? So come out of your comfort zone and start investing. Thank you.
So have any REITs been listed in the stock exchange in Sri Lanka? I think that's a straightforward question. You can answer it in a second.
So no, REITs as a product, REITs is, for those who don't know, real estate investment trusts, right? It's where a fund has a collection of real estate assets in it, and you can buy a unit of it. So we'll say you don't have money to buy a full apartment or a property. There is this product called REITs. Again, it's a collective investment scheme that can hold a portfolio of real estate, sell smaller units of that to the investing public, and thereby you can get the upside of that property valuation or that upside in real estate in a small way. That's what a REIT is. We launched REITs, the Colombo Stock Exchange launched REITs in 2019, I think, or 2018. However, there is not a single REIT that has been launched because of two issues that are hindering that. The first is that the regulator, that is the Securities and Exchange Commission, has put a rule that the REIT can only invest in a property that is already generating rental income. Right? And in Sri Lanka, rental yields are very low. They are at about 5%. So if you buy a property that's worth 10 million, you're probably going to generate a 5% return if you rent that property. Right? It's lower than fixed income. It's lower than what you'll get at a bank. So therefore, there's a disincentive there already built in. Most of the property appreciation in Sri Lanka comes at the development stage. So if you take an apartment, they sell to you, okay, alright, I'll use this example, I hope Prime doesn't mind. If they pitched it at 69 million to you with a payment plan, right, that's the launch of the product. So it's discounted. When they go up to the 10th floor and the project is now nearing completion, maybe 6 months more to go to handover, I'll bet you he won't sell it to you at this price. Because now it's appreciated. So then it will be, the 69 is with his ROE of 95%, probably 75 million at that time, right? So the appreciation of investing in real estate comes from at that early stage because you get the development gain. So the REIT being not allowed to buy development property and only property that is already made after this comes up, it won't be at 69 million, it will be some other price, I can guarantee you that. That is prohibitive. So therefore, the REITs don't have an option to invest. The second reason is there's stamp duty on all real estate transactions every time you buy and sell. The government charges you 4%. So the REIT, if it keeps buying and selling, is having to pay 4% every time. That dilutes the yield. So because of this reason, the product isn't popular. It's not viable, right? In other markets like, we'll say Japan, interest rates are virtually 0% and property appreciation is 10% and rental yields are 7-8%. So you can make money on a REITs, and that's why. So there are REITs, but it's not taken off.
Okay. Thank you for that. So here's something personal, something directed at you. If you had to start all over again at zero, what would you do differently than when you start?
If I had the advantage of hindsight, I know which stocks to buy, obviously, but I'm sure that it's a trick question. It's saying if I had to go back, I would definitely not make the same mistakes that I made, right? So I would avoid those 10 pitfalls that I gave you, which I have experienced personally. Yeah, they are not from a book. So I would avoid all of those 10 mistakes and do exactly what I told that you would do. Personal interesting story for you, I've always been a risk taker, right? So my risk appetite, like I said, so don't compare me to you. I have lost all my wealth thrice over in life. I've gone to zero and come back up, gone to zero, come back up, gone to zero, come back up. The last time I went to zero was in 2020, so it's just 5 years ago. And I come back up.
That's scary. Okay, so if anyone were to get into trading crypto, how would
that also says I don't know a lot, huh? So that's why I said don't take all my advice.
Okay, so if anyone were to start trading in crypto, how would you recommend them to start trading safe without falling prey to any scams?
Sorry, don't know the subject, never invested in crypto, so I can't advise you, and I won't try to pretend that I know anything about crypto. The only thing I can tell you, it is illegal to invest in crypto right now in Sri Lanka. I'm cleared by the central bank also as a fit and proper, so I can't advocate investing in crypto, but I don't know anything about it. I know a lot of people who made money investing in crypto, but I know nothing, so I'm not going to pretend to. I don't know, so I can't answer the question.
Okay. So here's a tip that someone's looking for, and I'm sure you give something useful. You mentioned that people should avoid panic selling due to external events. So when does it become a smart reaction? What should we look out for?
So keep looking at the fundamentals. So don't react to a market-based reaction for some external event that you don't know will have an implication, right? So it's like this. We'll say you bought a stock. We'll say you bought a banking share. Let's just say commercial bank. You bought commercial bank. Now, if the news is pertaining to commercial bank, we'll say bad. There's been a big fraud in commercial bank, there's been a cyber attack, their system has crashed, customers have lost their money. I would be worried with my share about commercial bank. Okay? So I'm not telling you to disregard a news or disregard panic or action if the news is in relation to the share that you bought directly or indirectly. But if it is in the example I gave you where Israel bombed Iran and a conflict arose in the Middle East, it's still an unknown. We don't know how that's going to pan out. Now, had you invested in the stock market prior, I'm saying avoid a panic reaction like that. Because over the last 4 days, a lot of people panicked and sold and got out and lost money. But today the market corrected, right? And now there's talk that they will have a 2-week ceasefire. So these things evolve. So that's the type of panic I'm asking you not to get caught to. So it's not that not to react to any news. Just choose to react to what is going to have an impact on your stocks or your portfolio.
So I just highlighted the word sell. So it's not in the question. But if I ask you, what about those who want to buy?
So both, I showed the bull and the bear. So you can make money out of both sides of it. So don't restrict yourself to saying I am buying or I am selling. You can do both in tandem or together rather, right? So you may choose to buy share A and you may say, look, B is overvalued, so I want to sell it. You can do both. What I'm only pointing out is that a lot of people think you make money in the share market by only buying a share and selling it at a higher price. It is not the case. So if there is a share that you see is overvalued, that you think, look, I can't understand why this is actually so high. And part of the problem we've had in previous occasions, speculation has driven shares up like, from again, I'll just pick a stock that is not speculative, but okay. Expo Lanka. Have you all heard of Expo Lanka and the run that Expo Lanka had? So Expo Lanka in probably early 2020, Jan Feb was at 2 rupees and 50 cents. Okay. That share in 2022, I think peaked at 400 and some rupees. Okay. So 200x almost, 200 times sort of a return. But there was a story behind it, right? But at a point, you thought it was overvalued. Let's say at 400, you thought it was overvalued. I personally thought it was overvalued, right? You want to ask me a question?
Because 250 is a market people are talking about it as overvalued, right?
At 250? So it went to 400. It went to 400, yeah, probably.
2017 was 5 rupees, right?
Maybe. I can't recall the numbers, but I know it was 250 that went to 400 in a matter of probably 24 months of a period. So you can actually, let's say you don't have Expo, you missed the bus, right? You didn't buy it at 250, now it's gone to 400, you missed the bus, but you really think, look, 400 is unrealistic. Short sell the share. Short it. You can short it through a broker today, right? So you can do that also. You don't have to always be buying. You can also be selling and making money. I hope that answers.
Okay, so here's a question about international markets. Over time, eventually people grow wealth through stock markets. What can be done to expand or open up people to invest in international markets?
You have to open up the capital account. Unfortunately, we are still emerging out of a crisis and you can't freely convert rupees to foreign currency. So it's limited. You can't take your money out Therefore, you can't invest in foreign markets. But in 2018, prior to the crisis, up until somewhere in 2018, the government allowed up to $100,000 per Sri Lankan to take it overseas and invest. So you could legally take rupees out to the equivalent of $100,000. At that time, the dollar was at trading at 200 rupees. So we'll say about 20 million rupees equivalent in dollars. You could have taken and invested. When central bank will allow that, I don't know. I don't think it's going to be in the near future. We've just opened vehicles up now, so I would think maybe when we have about $10 billion of reserves, no more crisis, we are servicing our debt, we have access to borrow foreign money again. I would think central bank may revert back and allow some element. So then anyone can legally take their money and invest in overseas stock markets. But I know nothing of that in terms of recommending stocks. However, the principle still applies. So even if you take your money to overseas market, the theory I taught you and the tips I taught you are valid.
Okay, we have to have a hard stop at 7, so we have 3 minutes. So just to wrap up, here's a question. So we stand here today. Could you give any opinion? I know there can't be a prediction or forecast, but your opinion and thoughts about the near future of the stock market and what should investors be looking for? Because you're just out of the office of being chairman of the Colombo, okay? And you had a good run. Congratulations for that. It was a good stint that you had. Now that you're out, what would you suggest that people keep an eye on right now? Because in January you did say that there will be so many IPOs coming up. We did see that. It's coming. People say, but what do you think?
Yeah, so I'm not going to pick stocks for you, but I'm wearing my First Capital hat on. We do recommend a set of stocks. Obviously, I have to back that, right? So that's there. That information is out in the public domain. We are one company that shares our research with everyone, not only our clients. You can log on to First Capital's website or subscribe to our WhatsApp and get all the research. What shares are we saying? Our buys, what are we saying? Sells, what are we saying? Holds, unknown public information. Anyone has access to that. But I'll tell you, I'm bullish on Sri Lanka in general first. Okay, so the country. I'm betting on the country, right? I think we are going to have good growth over the next 4-5 years. We are going to grow at between 4 to 5%, right? We have a stable government now. You can't change it whether you like it or not. They are in power. They have 5 years of a term to go. So does the president. So it's very, very unlikely that there's going to be any change in government. What that means is that hopefully we'll have consistency in policy, right? If you just rewind 10 years back, can anyone tell how many governments we had? We had 5. We have 5 governments that changed, right? From the Mahinda Rajapaksa to the Yahapalane to the Gotabaya to chasing him out, then the Ranil, and now this JP. So, right, and our policies, whatever the policy, tax policy, any damn policy that you look at, every government changed, right? Now today, we stand at a point where hopefully they are not going to tinker with that anymore. What we have now is going to be what is going to be there for the next 4.5, 5 years is my bet. So we'll have some consistency. We've seen that as long as peace is there, tourism is growing, our remittances is growing, we've recovered back, we'll get access to foreign markets. So growing at 5%, this economy is going to grow, right? And it's going to do well, and it's going to have a lot of foreign interest that also will come with time. So based on which, I think then even interest rates, which are now at one of its lowest points, will probably remain at that low level, right? Which will stimulate people to hunt for yield. Now, if your bank is only going to give you 7%, and then you pay tax on that 7%, right? And we'll say your tax at the highest bracket of 36%, your net return is less than 5%. You're getting 4.5 to your hand, right? So if inflation in the country, we'll say, is also around 4.5, 5, your money is not growing. You are going to be where you are. Your wealth is not increasing, right? But if you look at alternative investments, right, and we'll pick equity in this case, the last year's return on the ASPI was 50%, right? And that's free of tax. Capital gains are zero tax. So your 50 is 50. If inflation is 4.5, 5, you've grown your wealth by 45%. You also get dividends from companies. Dividends are taxed at 15%, it's deducted when you get it to your hand, and it's final. So the equity class of an asset is more tax efficient than fixed income or interest bearing, right? So as long as it outperforms the interest rate you're able to get, you're better off anyway, right? Point number one. Point number two is I'm not going to pick stocks and tell you invest in this, but I'm going to tell you about our market, right? The market has a valuation basis, right? And the two most famous valuations that anyone uses is what is called a price earnings multiple and a price to book multiple, right? A price earnings multiple of the market, all these 285 companies, is when you look at how much profit they all make, right? And look at that in terms of the price of the share, right? You can get a multiple, right? So you divide the earnings by the price of the share, you get a multiple. Lower the multiple, better the value, because you're buying it cheaper, right? So it's better for you, the upside is more. The price earnings ratio of the Colombo Stock Exchange as of last month is 8.5 times on trading earnings. What the companies were earning the last quarter, right? 8.5 times. If you just look at any regional market, there is no market other than Pakistan that is below 15 times price earnings. India, the National Stock Exchange, NSE, is at 22 times price earnings. So we are more than 50% cheaper as a valuation in the market. Number one. Then you have price to book. That is, if you liquidate all these companies and look at their asset value against the share price, what is it trading? Is it trading higher than the asset value or not? Our market trades at 1 time asset. So the share price is trading at its actual intrinsic value on the book, right? Other markets trade at around 1.7 to 2 times. Singapore is 2 times. India is even trading at 3 times in some sectors, right? So regionally, compared to anywhere in the world, we have one of the cheapest valued stock markets. That's a fact, okay? Also, now you have a lot of people like yourself who may have got educated through listening to a crazy guy like me and say, hey, maybe I'll go and now put a little bit more money in the stock market. That will increase the demand cost of the shares. So my view is that it's a good time to invest. The market is undervalued. However, all those 10 apply and you have to pick the stock. Now, I'm not telling you buy any of the 285. Pick on the valuations what is the cheapest. So if I tell you my personal favorite, the banking sector, right? The banking sector is trading at a multiple of around 5-6 times price earnings. It's lower than the market average and it's trading at 0.6 or 7 times of book. So it's trading less than the intrinsic value. It's like me telling you this projector is worth 5,000, but it's there in the market for $1,000. Wouldn't you buy it and take it? That's all I'm saying. Thank you.
Amazing. So thank you so much. Let's see now the round of applause and how loud it is determines better. And it's loud enough. Yeah. Thank you.
Audience doesn't have any other questions?
No. Okay. So thank you so much. Thank you very much. I hope all of you all enjoyed the session and the tips that he gave. And I think it finished off pretty fine, don't you think? Yep. So a few thank yous. First of all, to our speaker today, Dilshan Wirasekara. Thank you so much for being with us, Managing Director, CEO of First Capital. We'd also like to thank all of you who made it this evening for the very first Beers and Business. I hope you liked it, you had fun. I hope it was short and useful. So thank you so much for making it here and asking those questions. And of course, our sponsor, Prime Residencies, thank you so much for providing the opportunity to make this a reality. I have a announcement to make at the end, and let me try to get that. This is not the first and the last of Beers and Business. So next Friday the 27th, so I hope that you diarize it, right? So next Friday the 27th at 6:30 p.m. We'll have a brand new topic, and that will be Digital Sri Lanka 2030. The person speaking will be Asela Vaidalankara, Vice President of the Digital Trust Alliance, who is an expert in cybersecurity, innovation and digital policy. So please do join for that. And what's left is people to mingle and have fun, stay back, get into high spirits, and so on and so forth. So thank you so much for joining us here this evening. It's been a pleasure in this venue. So a round of applause to everyone who made it possible. Thank you so very much. And my name is Ashik Al-Muddin, and very happy to be with you this evening. Thanks a lot.